Today, we're going to dive deep into the mind of a true market legend, Mark Minervini. We're going to distill his wisdom down to the single most important habit for trading success. And here's a spoiler. It's not about finding the perfect stock. It's all about what you do when things inevitably go wrong. This quote from another giant, Paul Tudor Jones, just cuts right to the chase, doesn't it? It perfectly captures the brutal, high-stakes reality of the market. You will have catastrophic losses, and you will have unbelievable winners. The whole game, and I mean the entire game, comes down to how you manage these two extremes. Your survival, let alone your success, depends on one thing: cutting the losers short and letting the winners run.
Look, everyone buys the wrong stocks sometimes. I mean, even the absolute pros get it wrong. That's not the fatal error. The real mistake, the one that just blows up accounts, is what happens right after you realize you're in a losing trade. It's this psychological trap that feels so logical at the moment, but leads you straight to ruin.
And this is where we really get to the heart of the problem. The goal is always to compound your money, right? But what most beginners end up doing is compounding their mistakes. They take one small error and, through one very specific, very common action, they magnify it into an absolute disaster.
Oh, this is the siren song of the losing trader. I bet you've heard this logic, maybe you've even thought it yourself. It sounds so simple, so seductive. Hey, it's on sale. I thought it was a good buy before, so now it's a total bargain. This is called averaging down, and it's basically the financial equivalent of throwing good money after bad. You're not buying a bargain, you're just doubling down on a mistake. Paul Tudor Jones literally had this quote posted above his trading desk. Just think about that for a second. One of the greatest traders of all time needed a constant, blunt reminder not to fall into this trap. So what's the lesson? It's simple. When a stock goes against you right after you buy it, you were wrong, period. Buying more doesn't fix your mistake, it just makes it bigger.
Now this is where it gets really scary, because Minervini puts hard numbers to the danger. He calls it the 50-80 rule. When a high-flying, market-leading stock finally tops out, there is an 80% chance it gets cut in half, and a 50-50 shot that it loses a staggering 80% of its value. That small pullback you're thinking about averaging down on, it could be the very beginning of a complete and total wipeout.
So this isn't just about a technical mistake. It's a deep-seated psychological one. Even traders who know the rules, who know they shouldn't average down, they often find themselves doing it anyway. And it all starts with a very dangerous forward phrase.
It always starts with, just this one time. You know you should sell. Your stop is hit, but you hold on. And sometimes, and this is the worst part, it works. The stock bounces back, and you feel like a genius. But that is the worst possible outcome, because it rewards a bad habit. It teaches your brain that breaking the rules pays off. And once that idea takes root, your discipline is pretty much gone. And this, right here, just brilliantly illustrates the core difference. The amateur holds on to a losing trade because their ego is on the line. They need to prove they were right. The professional? They couldn't care less about being right on any single trade. They only care about being profitable in the long run, and they know that means cutting losses quickly and without any emotion. Come on, be honest with yourself for a second. Think about a time you knew your stop loss was hit. You knew the plan was to sell, but you held on just a little longer. You told yourself, it's just this one time. Did that decision ultimately make you rich, or did it just pave the way for bigger, more painful mistakes down the road? All right, enough about the problem. Let's pivot to the solution. What does the professional's playbook actually look like? Well, it's all about discipline, it's all about risk management, and it's all about putting the mathematical odds firmly in your favor. This slide makes it so clear. Trader A is making a one-to-one bet. They're basically just gambling, flipping a coin. Trader B, on the other hand, is operating like a casino. They risk just 5% to make 20%. That's a 4-to-1 reward-to-risk ratio. With odds like that, you don't even have to be right half the time to make a whole lot of money. That's a real mathematical edge.
According to Minervini, your priorities have to be in this exact order, no exceptions. First, and most importantly, you protect yourself from a catastrophic loss. That's your initial stop loss. Then, as the trade starts working, you move your stop to break even to protect your starting capital. Only after that do you start thinking about locking in the profit. Defense always comes first. This is such a critical mindset shift. Once you make a profit, that money is yours. It's not the market's money anymore. Amateurs get careless with their profits and just let them evaporate. Professionals, they protect those gains just as fiercely as they protect their initial stake, because guess what? It's all part of their working capital now.
So, you've got your risk management dialed in. What's the final piece of the puzzle? Well, it might just be the hardest one of all. Developing the discipline to do absolutely nothing until the perfect moment arrives.
I absolutely love this analogy. It just perfectly captures the essence of professional trading. You aren't in the market for constant action or entertainment. You are a predator, patiently waiting, conserving energy until a high probability opportunity presents itself.
Let's just break that down for a minute. The cheetah could be starving, but it's not going to waste precious energy chasing something it has a low chance of catching. It waits. The gambler, on the other hand, needs to be in the game. They get bored, they get antsy sitting on the sidelines, so they force trades that aren't really there, taking low-probability bets just for the action. Which one do you think survives in the long run?
So at the end of the day, the crucial point is this. Trading is not about hitting one lucky home run. It's about following a disciplined process. Anyone can get lucky once, but the real goal, the pro's goal, is to develop a consistent process that keeps you in the game for years, maybe even decades. Longevity is the true key to super performance.
Ultimately, it all comes down to this single question. Every decision you make, every loss you cut, every rule you follow, every bad trade you pass on, is a vote for one of these two paths. Are you building a professional career that can pay you for life? Or are you just visiting the casino, hoping to get lucky? The choice is always yours.